Let's round up all the business news for you now. And markets fall for the third consecutive day, ending at the lowest in 2 weeks. Nifty ended below the 19,750 mark, while Sensex dropped over 550 points on the day. Broader markets underperformed. The benchmark indices at most sectors ended in the red. Alex Matthew with a wrap of all the market action.
Indian equity markets fell yet again for the third time this week, and this is in line with a lot of the Asian peers. The Nifty 50 fell close to 150 points today, taking the fall for the week so far to over 400 points. Now, the Asian markets have declined in line with what happened overnight, with the Fed making more of a hawkish statement than was expected. They have indicated that there could well be another rate hike this year, and it was widely expected that the Fed was done and dusted with its rate hikes. Now, speaking about the broader markets in India in the session today, they underperformed the benchmark index, and you saw the mid-cap index lose about 0.9%, and you had the small-cap index that was down about over 1% in trade. Now, most of the sectoral indices ended in the red, and you had the Nifty Bank that was the worst performer, down about 1.7% for the day, and you had the PSU banking pack that underperformed even more. In fact, it ended lower by over 2%. The top gainers on the Nifty 50 were Adani Ports, Tech Mahindra, Dr. Reddy's Laboratories, Asian Paints and Bharti Airtel. And among the top losers, you had Mahindra & Mahindra, ICICI Bank, Cipla, SBI and IndusInd Bank. You saw a couple of banking names there. Mahindra & Mahindra, the worst performer on the benchmark, lost over 3% after the announcement of a voluntary wind-up of one of its Canadian associate companies. It's not really related to the tensions between Canada and India. EMS listed at a premium of over 30% and was arguably the stock of the day today. SJVN, on the other hand, dropped over 10% after the announcement of an OFS, or offer for sale. All told, where losing ground did gain very sharply in the recent past, and one could argue that some of this is profit-taking.
Now, India looks to maintain the current account deficit at the present level. This, according to Axis Bank's chief economist, Neelkant Mishra. Is a growing current account deficit a negative sign for the economy? Here's what he had to say.
I think there is a very reasonable chance that we do become current account surplus. There is a macro, there's a demographic reason for that. So whenever your total fertility rate drops below 2.1, for the next 20-25 years, the number of consumers per producer keeps dropping because your low age dependency ratio is falling. After 20-25 years, the old age dependency ratio starts to go up. So that's when the savings rate starts to come down. But for these 20-25 years, every individual will be saving more. One manifestation of that is what we have written extensively on what India's business services exports are doing. And we think that if business services exports, the way they are growing, and I think we expect them to grow, that this will potentially take India to a current account surplus in the next 3 years. So that's the predictive aspect. Now, if you take a slightly prescriptive aspect to it, I hope that we don't get to a current account deficit, a current account surplus. And the reason is that, in an economy where we have to grow really fast, a current account deficit shows that we are investing more than what we are saving, and therefore we're using external capital to grow faster. And I would rather that we grow faster.
The Reserve Bank of India is currently deliberating on the role of big tech firms in India's financial system. The central bank is mulling steps to keep big tech in check. So what is the RBI deliberating? Vishwanath Nair joins in with the details.
Sources telling BQ Prime that an internal group within the Reserve Bank of India is looking at ways to curb the impact of big tech firms on India's banking and financial system. What sources are telling us is that currently an internal group is deliberating ways in which such measures can be taken, which will limit the impact of big techs. Remember that big techs have been a problem for the RBI for a very long time. In private as well as public gatherings, the RBI has been expressing that big tech firms pose an unknown risk towards the Indian financial system, simply because these are large technology firms with complex corporate structures, and therefore it is difficult for a regulator or other regulators within India to have effective oversight over these companies. Now remember that these deliberations have not yet moved in the direction of regulations for the big tech firms which are active in India, but if in case it does result in any kind of regulation, it could come in the way, in the form of tougher data localization norms or higher regulatory burden on bringing on customers on board for these big tech firms. What the RBI is not looking to do is ban these firms within the Indian banking and financial system, because typically entity-based regulations have unintended consequences. So the RBI is trying to avoid an outright ban, but is looking to impose higher regulatory burden on these companies. In case these norms do come up, and if the RBI does impose any kind of tough regulations on these companies, then that may see a seismic shift within the Indian banking and financial system, because currently, if you remember, within UPI, which is one of the most popular payment mechanisms in the country, Google Pay is the second largest player in the market. So in case there are tougher norms for companies like that, then that may result in smaller fintechs getting more room in building their business and growing into sizable shape and form within the financial system.
What is the future of LNG in India? Will there be more takers for the alternative fuel in the long term? BQ Prime was at the Adani Total's Dhamra LNG terminal to speak with CEO Satinder Pal Singh about the future of LNG.
LNG is referred to as a transition fuel, but my humble submission is that if the transition is going to last for 30 years or more, we cannot just think of it as a transition which is going to fade away anytime soon. We've got to make long-term commitments to really help the growth of natural gas penetration in India's primary energy mix. At this point in time, India's share of natural gas is less than 6%, about 6%. The Honorable Prime Minister has, with a view to meeting our net zero targets of 2070, our greening targets, there is an ambition to grow the share of natural gas to 15%. India imports half its natural gas consumption in the form of LNG. So therefore, LNG, unless and until we grow LNG's penetration and LNG's consumption in this country, there is no way we are ever going to hit the 15% target or even get close to meeting our net zero targets that we've set ourselves. LNG is the cleanest burning fossil fuel. It is affordable compared to the liquid fuels it hopes to substitute. And therefore, my vision for LNG in the country, and Dhamra is part of that vision, is to see more and more users committing long term to buying LNG. Because unless you structurally adjust your energy needs to burning LNG on a long term basis, you'll always be reliant on the spot market.
And that's a wrap of all the business news.